that at all. So I'm just going to be talking about chapter 7 and 8. I know I'm a little bit early today, but I got some things to take care of because I'm going to be watching football later and probably watching Al trade maybe today or tomorrow or whatever. But let's go ahead and get started. So here's a reference slide. Outside bars, I'll just go ahead and move on. Like outside bars, in general, they're pretty tricky. So let's talk about, I want to be very thorough when I talk about them. What is an outside bar? Well, it's when the high of the current bar is above the high of the previous, and the same thing for the low. So it has to occur simultaneously in general. So if you look at this, this picture, this bull bar, outside bull bar, went below the previous bar, and the high is above the previous bar. So that is an outside bull bar. And a lot of times, depending on the context, outside bars normally show up in trading ranges, and you don't actually want to do anything besides fade outside bars in trading ranges. We'll get into that in a little bit. But the outside bar itself also can be considered a one bar trading range, especially if it closes in the middle or maybe it closes as a doji. Definitely you have to think buyers below, sellers above when that happens. And then I also included the almost outside bar because this happens a lot. And I love this saying from Al. It's on page 161. Close, or not the saying, but like this outside bull bar, right? He always talks about how if a pattern is close enough, it's going to give you like that result. Like if a head and shoulders pattern, maybe it has like a slightly larger or higher right shoulder, but it still breaks down. The result is the same. It's very difficult to find perfect patterns in the market. So a lot of times you're just going to get, almost perfect. And the function is still going to be the same. So don't be afraid to take it. Moving on. So let's talk about trading the outside bar, what you want, what you don't want. So again, I want to emphasize this. Outside bars do require context, and they can be tricky because sometimes your stop is very far away. And not everybody wants to risk, 5-6 points in the E-mini or 20 to 25 points in the NASDAQ, whatever your instrument that you're trading. On big outside bars, you should not enter on stop limit. It doesn't matter. I think if it looks decent for a reversal, you should not enter one tick above that outside bar. You can do two things, right? You can buy a limit order on a pullback. You can do three things. You can buy a limit order on a pullback, maybe 50% pullback if you measure the bar. You could wait for a higher low or a lower high to buy or sell. And I should have included this, but also you can just wait to see how the follow through looks like. Because if you get follow through from the outside bar off of, let's say, a reversal, then the likelihood of you making money is high. So maybe your targets, and I'll talk about this too, is you don't want to buy one tick above unless there are targets above. Your target could be a measured move breakout of the outside bar body. Maybe it could be a 1-to-1 or a 2-to-1 for a swing. And the next slide will talk more about that. If the outside bar is following a trading range, it will be a bad buy or sell. And there's two examples here that I pictured. So, we go up, create a bull channel. To me, bar 36, almost outside bar, is the first attempt. Maybe some people would argue that bar 30 here is the first. Either way, 2 attempts is usually not good enough to break a bull micro channel or just a channel in general. So it's a bad sell here, right? Because it's forcing you to buy low in the channel trading range. And yeah, you could argue 37 had follow through, but I wouldn't sell bar 37 either. There's just too much bullishness to get a big trend reversal at the moment. Not enough bear bars. It's only 3. And then over here in this more clear trading range, almost outside bar 43. But it's not a great sell because look at the trading range. We've kind of been in a trading range on this chart since bar 18, which is here. And if you measure bar 18 lows to, let's say, bar 24, maybe 25 highs, where's bar 43 close? Well, it's closing in the middle of the trading range. So you don't want to sell bar 43. If anything, right, you'd want to fade it. Although I would not enter at all on a candle like this, buy or short, or long or short, because we're in the middle, and you don't want to be in the middle of a trading range. But this is where that context comes into play when it comes to outside bars, because they can trick you like this and think, oh, well, look at bars, 38, 39. Bears might can get a second leg, maybe it's good enough. Well, it's best to just wait and be patient. Nothing when you look left says that we're breaking up or down, at least for this little part of it. Good outside bars are usually a form of reversals or with trend setups. And here's a good example of a good outside bar, even though it's kind of big. But if you think back to chapter 5, 2-bar reversals, for example, or maybe that might have been chapter 6. Think back to last week when we talked about reversal bars, okay? When we talked about reversal bars, there are some criteria that you need to get to meet in order to take a counter trend trade. And 2 of them are very apparent here. So we have a test of the extreme. It's a wedge. You can consider the wedge bar 1, bar 5, bar 10, or heck, even bar 11. Or you could say the wedge is bar 5, bar 6, bar 11. It doesn't matter. There's at least 3 tests here. And that's the most important thing. There's at least 3 tests. And so we're testing an extreme, and then you have a 2-bar reversal. Bar 10, bar 11. Bar 11 is the outside bar. So what can you do? So I measured this. You could not have gotten in on a limit order here, but you can buy 1 tick above bar 12, or you could buy the close of bar 11 because there are targets above. Either one is fine. And you can go for 1-to-1s, 2-to-1s. Eventually you did get a 3-to-1, but it just depends on how long you want to hold this. And the reason why I want to emphasize it's a good buy, it's a good buy the close or 1 tick above, or maybe waiting for bar 12 follow through, is because of the 3 push wedges down, and it fulfills criteria of a true reversal. Okay? Bar 6, nice outside up bar, but where's your 3 pushes down? It's not completing the criteria necessary for a reversal. Could the bulls have bought it? Absolutely. Would we have been in on it? Or at least I can say for myself, no, I would not have. I would have waited for a higher low. We have to have these criteria met before we can look for swing longs in this scenario. And at this point in the day, it has not been met. There's no 3 pushes down. There's only 2 at this point, and it's bar 1 and bar 6. So let's move on. Hold on. Let me let my dog calm down. Okay, I think he's done. Oh, nope. Okay. With trend bars, right? Outside bars are tradable with trend if you have a trending day. So with this chart, we have a trend from the open. Bar 1 sets the tone of the day. Double top bar 1, bar 4, and we get a bear breakout followed by an inside bar, and a bull breakout of this, what I would consider a bear flag. It's kind of like a triangle. The thing about triangles that I talk about, and I'll keep it brief because this chapter is not about them, is they often love to test the apex or the midpoint. So you have you're getting a tighter triangle. I can't think of the word. Getting a tighter triangle here, bar 8, bar 9. Bulls breakout, but oftentimes they reverse. They test the apex and then they can reverse. So you have an outside down bar because they went one tick above bar 11. This is a bar because of the previous price action today that you can sell the close, sell one tick below on a stop order, and you have a good chance of making money here. Okay, and you can just see the chart. And I think the setup is beautiful because it's a bear flag fake breakout from the bulls and outside down bar. I mean, it doesn't get much better than that on a day like today. So that's the way that I see outside bars. As long as you have the appropriate context, even though sometimes your risk is big, you sell the close of bar 11, where's your stop? Probably one tick above bar 11, maybe even a whole point above bar 11. So it's a big stop, but you see this, you're probably going to get more down price action. So it's a good sell below. Chapter 8, the importance of the close of the bar. This is the only slide for this chapter. One, because I kind of emphasize the close of bars all the time when I'm trading live, but also because I think it's important for everybody to read this chapter. One, it's a very short chapter, but if you just use these slides as sort of reading the book, which is totally fine. If there's a chapter that we have gone through together that I would recommend sitting down and actually reading, it's this one, and it's a short one. But he just talks about how waiting for closes is extremely important because the signal bars that are forming, right? They can change in the last minute, and they often change in the last minute to last 10 seconds. And he talks about how it's one of the words of wisdom that I have here. Essentially, he's saying that if you enter as bars form, most of the time you might get an extra tick or two. And keep in mind, he wrote this book a long time ago, so now I'd say maybe you get an extra point or two of profit. But once or twice a day, you'll lose 8 ticks, so maybe 3 points, 4 points, something like that today. And that might, if you're a scalper, that might actually, kill your day. So it's always best to wait for the close of the bars. The only exception would be if the market's racing. But if the market's racing, let's say up, and you buy at the market, it's a scalp. It's not a swing, so you're going to have to scalp out. But essentially, in my own words, the market can't hide anything in that bar anymore after the close. So it's very clear what the market just did for the past 5 minutes. Did the market break out? Did it close above or below a breakout point? Are we inside the other bar? Are we in a trading range? Where are we in the trading range? It's very clear for the past 5 minutes what we just did. And also, Al talks about how institutions use line charts. So if I'm talking about gaps, which he does eventually talk about in this book, if we're talking about gaps, you guys have seen me go to the line charts just to show you that they're easier to see on a line chart than a 5-minute chart. Although once you start to look for them on the 5-minute bar chart or candlestick chart, you can kind of just begin to see them, and they usually act as support or resistance, right? But the closes are what's important, not necessarily where the market opened up on the current or last 5-minute bar. It's always the closes. That's what people pay attention to. So the last thing I'll say is exits. I would recommend reading this paragraph, but sometimes, and I'm guilty of it too, sometimes you get anxious when you're close to maybe a take profit, or you just enter a trade and you're like, damn, I want this to go my way rather quickly, which is a normal feeling. Sometimes when you are not waiting for closes, you can be trapped out of a good trade, especially if you're trying to go down to the lower time frames. Say you're trading on a 5-minute, and you go down to the 2-minute, and you're like, oh man, I don't like that bear reversal bar, right? And you're long or something like that. You can you'll just exit out of the market, and then next thing you know, boom, a bar or two, maybe three, your take profit is hit. But the 5-minute bar never closed, bearish if you're long or whatever, right? So that's another reason, to wait for closes. Does this sometimes bite you in the butt? Absolutely. Sometimes waiting for closes, you'll get out at a worse price, but if you're reading the market correctly, it won't happen enough to where it puts a dent into your P&L. So I think it's important to remember that. And it also kind of builds like a sort of discipline, right? Because you tell yourself, hey, I'll wait to enter when the signal bar closes. That way I know what it looks like. Hey, I'll wait to exit, either at my take profit or on the bar close, because then I know the market can't hide anything and I can make a reasonable assumption as to what we're going to do next. So it kind of built like a discipline in that way too. And I recommend on page 170 reading paragraph 2, because he'll go into more depth about the exit on why to wait for closes. And then words of wisdom. I love this right here because I think we all kind of try to look for perfect patterns or perfect signals in trading, or we look for a perfect system, but it just doesn't exist. And I know it's not exactly what he's talking about here, but it just kind of is like, oh wow, just reminder, something in the back of your head. But he says, in trading, something is almost a reliable pattern, it will likely yield a reliable result. And I talked about that earlier with the outside bar, the almost outside bar. And then the next thing that I saw was a 5-minute bar assumes something similar to its final appearance, seconds to a minute or more before the bar closes. If you enter before the bar closes, you might occasionally make a tick or so more on your trade. However, once or twice every day, the signal that you thought was going to happen does not, and you will, I should say, lose about 8 ticks. Grammar. I talked about that earlier, and I agree. I don't think, like in the Discord, I talk about how entries aren't super important. It's not that they're not important or that you can just enter willy-nilly. You can't. But is there really a difference if you get a 1 point worse entry, or even 2 points in some cases? Is there really a difference? No, I don't think it's enough of a difference. I don't think $50, per contract is enough of a difference to make on your P&L. So, because I always see a lot of people focus on the entries because they think if the entry's perfect, they're going to make money. But that's just simply not the case. You can have a great entry, but you can, die to 1,000 paper cuts because you're trying to long something that's falling or whatever, We've all done it. So I think it's just more important to focus on how good the signal is, where do you think the market can head, and why. And as you do that, at first you'll be slow, but the 5-minute chart gives you time to analyze, before the bar closes, and to make a reasonable assumption, and to find your stop loss, to find targets. So yeah, I don't think the entry is the most important part of the trade. In fact, I think the most important part of the trade is actually just managing it. I don't think the exit's the most important part, and I don't think the entry is the most important part. In fact, if I had to rate them from 1 to 3, I would go management, exit, entry. That doesn't mean the entry isn't important. It is. It's just I don't put a lot of emphasis on it. So, but anyway, guys, that's it. I know I started earlier, but like I said, I got some things to do today. So I'll post the link in the Discord, and that will be that. See you later.